We now begin with the era of the Committee on Accounting Procedure, a committee of the American Institute of Accountants, which served for 21 years from 1939 to 1959. I've already referred in this little paragraph under A to its composition. It was composed of partners all across the country. Now, this was the first standard-setting body in financial reporting anywhere in the world. No other country had taken this step, and so there was no previous experience anywhere in the world, to say nothing of in the United States, on which to build. And these partners and academics were coming together for the first time, most of them not having known any of the other people who were on the Committee on Accounting Procedure, and were unaccustomed to, in effect, making recommendations. And they had to do it by a 2/3 majority. And since there was a natural reluctance on the part of the partners, particularly on the part of the partners, to recommend against the use of certain accounting methods that were used by their clients, it was very difficult to get them to agree to narrow the areas of difference, which was a continuing source of frustration to the chief accountant. The CAP, as I say, was the first accounting standard setter anywhere in the world. It began a somewhat tense relationship. The SEC, a public sector agency possessing legal authority to compel listed companies to comply with accounting norms, and the CAP, a private sector body composed entirely of part-timers, most of whom had clients who had vested interest in the CAP's recommendations. And so as long as the standard setter, as we'll come to see, has been composed of part-time members, including a majority made up of partners in audit firms, I suspect that the commission was suspicious about its dedication to narrowing the areas of difference, and therefore oversaw its operations and recommendations very closely and engaged in a mentoring relationship with the Committee on Accounting Procedure and its subsequent Accounting Principles Board. Now to a sampling of some of the conflicts that existed in the 30s and 40s during the period of CAP. 1944-45, the CAP and the SEC crossed swords over what to do about goodwill once it appears on the books. In Accounting Research Bulletin number 24, the CAP said only that the write-off of unlimited life intangibles like brand values and goodwill against capital surplus should be discouraged. It didn't go any further than that, adding, since the practice of writing them off to capital surplus, which many companies were doing, has been long established and widely approved, the committee does not feel warranted in recommending at this time adoption of a rule prohibiting such distribution. The SEC promptly disagreed and said if it is not a proper method, it should be prohibited. And it declared in an accounting series release that in no event would it be permissible under sound accounting principles to charge the write-off of goodwill to capital surplus. So therefore, the SEC overrode the Committee on Accounting Procedure because the Committee on Accounting Procedure was unwilling to recommend against the use of a method that had fallen into disrepute, but still was widely used, that is, widely used, among others, by their clients. In 1947, the CAP in Accounting Research Bulletin number 32 came into conflict with the SEC over the treatment of extraordinary items, major gains and losses as a result of natural disasters or any other one-off events. The CAP said that they should be charged or credited directly to earned surplus, that is, retained earnings in our terminology. That was called the current operating performance notion, favored by companies because they preferred not to have their net income made volatile by significant losses and gains, especially significant losses, charged against their income in a given year when the event that triggered the loss was not under the company control, such as, say, a hurricane. While the SEC said that the extraordinary item should be reflected in the determination of net income, called the all-inclusive or clean surplus notion. They felt that this all should be reflected in net income and should not be circumvented around the income statement and be charged against earned surplus. After this public dispute, they agreed on a compromise presentation in the income statements filed with the Commission, such as is shown here. Net income or loss, special items. This would be a special item. Net income or loss and special items. That was the compromise worked out in filings with the SEC under Regulation SX, which I should mention was originally issued in 1940. It exists today as a very important document. Regulation SX of the Commission sets forth the rules and regulations mostly involving presentation, that is to say format and disclosure, not dealing very much with measurement issues. At the very bottom, you see a note. It was not until the 1960s that the Committee on Accounting Procedures' successor, the Accounting Principles Board, finally accepted the SEC's preferred keen surplus approach. But that was another conflict. During the CAP's 21-year life, the SEC chief accountant intervened. We've seen a couple cases already, sometimes forcefully, in the development of its recommendations. And here was probably the most important one. The chief accountant rejected 3 attempts by the Committee on Accounting Procedure to allow upward revaluations of tangible assets, property, plant, and equipment, including the use of general price level accounting. Well, this became a problem in the 1940s, and there was a feeling among members of the Committee on Accounting Procedure that there should be a way by which companies could increase the historical cost of property, plant, and equipment on their balance sheets to something reflecting the current replacement cost of their assets. Well, during the war, an awful lot of consumer durables were not available, such as automobiles. Everything was dedicated to war production. After the war, there was a pent-up demand, driving up prices for all sorts of assets that hadn't been available for 3 or 4 or 5 years. And so even during the war, just before the war, there was high inflation. 1941, 11% inflation. 1942, 7.6% inflation in the U.S. 1946, just after the war, 18.1% inflation. 1947, 10.2% inflation. So it was an inflationary decade, especially in the latter part, 1946, 1947. Companies saw themselves on the horns of a dilemma. Think of it, their financial statements, the income statement in particular. The income statement reflects revenues mostly negotiated in today's dollars. Virtually all of the other expenses are negotiated in today's dollars. Wages and salaries and utility costs and property taxes and income taxes. Virtually all of the major expenses are in today's dollars. But depreciation and amortization are not in today's dollars. They're in the dollars of the years in which you acquired the depreciable and amortizable assets, many of which were acquired in the 30s and the 20s, especially buildings, which meant that the depreciation expense appearing in companies' income statements, especially those that are industrial companies with large amounts of depreciable assets in 1947, would show a much lower amount in terms of what would be today's dollars because they're based on dollars paid 10 and 20 and maybe 30 years ago before the general price level increased and revaluations went up. Consequently, since the revenues are in today's cheap dollars, all the other expenses are in today's cheap dollars, but the very large item, and for many companies the largest single expense item, depreciation expense and amortization expense, were in older years dollars. These amounts were understated, the depreciation and amortization expense in terms of today's dollars, which meant that net income was overstated considerably in terms of today's dollars. That meant labor unions that were not allowed to press for wage increases and pension benefits during the war, but were doing so aggressively after the war, could look at these high net incomes and insist that companies begin granting very large benefits to their members. The companies were under assault in the media for showing such high profits. And even further, not only did this mean overstated and grossly overstated net income in financial statements, it meant grossly overstated taxable income and paying taxes on capital and not just income. And so many companies felt very grieved, and they began pressing the Committee on Accounting Procedure for authority to record upward valuations. There was sympathy for that on the panel, but there was no sympathy on it by the SEC. And so the SEC made it clear that historical cost accounting had to be retained at least until a period when there was price stability and everybody could move easily at the same time. There was not price stability in 1946 and 47. Nonetheless, in 1945 and 1950, the Committee on Accounting Procedure twice unanimously recommended upward valuations of tangible assets, but both times the SEC said, if you issue such an accounting research bulletin, we will not allow companies to follow it. It simply will be dismissed by the SEC, though the standards were never issued. And so here the profession wanted to do it, undoubtedly because many of their clients encouraged them to want to do it, but the SEC refused to budge. And so there was a considerable friction between the SEC and the Committee on Accounting Procedure in the late 1940s. There were several companies, such as U.S. Steel Corporation and Chrysler and DuPont, that tried to use what they called extra depreciation in their 1947 quarterly reports. The SEC refused to accept the extra depreciation and said you had to go back and use historical cost depreciation. So what did several of them do? They began to use accelerated historical cost depreciation. So the earlier years' accelerated historical cost depreciation might be more or less about the same as the replacement cost depreciation was under extra depreciation. So there was a real battle in the latter 1940s between the Committee on Accounting Procedure and, of course, many corporations that wanted to see revaluation allowed by the SEC and the SEC. Congress was unsympathetic to an argument to use replacement value depreciation. And by the way, in 1954, when Congress overhauled the Internal Revenue Code, for the first time, they allowed double declining balance and some of the year's digits depreciation using historical cost. And this was really intended to be a way of accommodating companies that wanted to use upward valuations and have depreciation based on it. Even though the Congress did not embrace revaluations, it came up with an approach to recording depreciation using historical cost that produced results that were more favorable to recognizing the effect of changing prices. And so this became a major issue in the 1940s and again in the 1950s. And in 1957, again, the Committee on Accounting Procedure tried to move toward, in this case, general price level accounting. And the SEC chief accountant said, nothing doing. We will not accept any accounting research bulletin with that particular approach. And so the post-war inflationary period, which was a precursor of the inflationary period in the 1970s, brought about a conflict between the SEC and many corporations and some members of the Committee on Accounting Procedure. The CAP, for its part, had great difficulty securing two-thirds approval of recommendations for a single accounting method, especially where more than one method was in widespread use. Then this inability to narrow the areas of difference continually frustrated the SEC and the chief accountant in particular. Leonard Spacek, the outspoken managing partner of Arthur Andersen and Company, which was a firm that was in favor of narrowing the areas of difference and promoting comparability, publicly criticized the CAP for allowing diverse accounting methods and for not promoting a uniformity of practice. Finally, in 1957, The American Institute of Certified Public Accountants, the American Institute of Accountants had just changed its name to include of Certified Public Accountants, created the study group to consider a better way of setting accounting standards because there was so much unhappiness, including at the SEC, including among quite a number of corporations who, in subjects that I haven't talked about here, were unhappy with some of the recommendations of the Committee on Accounting Procedure. And the study group was set up in 1957 and 58, and finally in 1958 they issued a unanimous recommendation. And it led to the establishment a year later, in 1959, of the more grandly titled Accounting Principles Board, another AICPA Senior Technical Committee, again composed of some 18 to 21 part-timers, mostly partners in the leading audit firms, plus several accounting academics, and for the first time, financial executives, and by 1971, even a financial analyst. All of them had to be CPAs because you could not be a member of the AICPA unless you were a CPA, and you couldn't be on an AICPA committee unless you were a member of the CPA, of the AICPA. And that financial analyst was himself a member of the AICPA. And finally, the Accounting Principles Board was to begin its work by agreeing on a conceptual framework that would guide its future opinions, and we'll have something to say about that in a few moments.